Good morning, everybody, and welcome to the November 2013 Mid-Michigan Roundtable. This is Ken Cavola, the president of the Mid-Michigan chapter, and I'm joined today, as usual, by my fellow knights of the Roundtable, Mark Robertson from Rochester Hills, Michigan, and Hugh McManus from Pasadena, California. Our third regular knight, Cy Lynch, out of Atlanta, is busy today, so we've asked a guest damsel to step in for Cy, and she has graciously agreed to pick a stock for us and help us out. Her name is Susan Michalek, and Susan lives up in Wisconsin. Janesville is the name of the town, and she tells me that it's just between Rockford, Illinois and Madison, Wisconsin, about 30 miles south of Madison. So Susan, welcome. Hugh and Cy, thanks. I'm sorry, Hugh and Mark, thanks so much for coming back today. And Mark, I'll turn it over to you for the rest of our introductions.
Okay. Well, good morning, everybody. And by the way, go Badgers, Susan. I know they've got a big game with Northwestern coming up later today. But welcome back, everybody. We see a lot of familiar names. We want to dig right into it. Those of you that may be new to this, so an extra big special welcome hug to you. We've been talking a little bit about hunting in the pre-session, something that we do around here, a little bit unusual to many webcasts, is kind of hang out a few minutes before. Sometimes we even talk about investing. But tonight, or I should say this morning, we want to talk about a different form of hunting and kind of pay homage to this notion of what we all know can be fun and effective, this hunting in crowds. We're going to talk about the results of the audience selections over the last couple of years here in a few minutes, and it's certainly going to be an interesting moment. But yeah, we do point to the wisdom of crowds, wisdom of communities, and I thank my fellow knights and damsels for their continued strong performance. Let's go ahead and dive right into it. Here's the standard disclaimer. No investment recommendation of any kind whatsoever is intended. This is for education and illustration and demonstration of some what we consider to be pretty powerful processes and philosophies nurtured and brought along by the modern investment club movement. So again, the word for the day is do your own homework, do your own hunting. Here's a quick look at the agenda, and we're going to try to move right along. This is basically our standing agenda where we will be taking a look at 4 stocks. Hugh is going to have a repeat selection of Caterpillar. Susan's going to feature Ulta Salon. Ken has a fresh new stock for us, Panera Bread, and then I'm going to actually do a repeat selection of Apple. But before that, we'll get started with a look at some quick results, a reminder of why we're here, maybe a little bit of time on the hot seat, and then as I promised, let's take a look at the audience performance over time also. And we will have a poll, so you'll be voting for your favorite of the stock presentations here today. As a quick reminder, we basically come here with full acknowledgement that stocks are a little bit harder to find right now in terms of an attractive stock with high quality and a good long-term return forecast, but the 4 of us are still trying to identify at least a single favorite opportunity that's near the top of our shopping lists right now. And as a group, we basically try to maintain a tracking portfolio that beats the stock market by 5 percentage points, versus the Wilshire 5000 general stock market benchmark. And we'd like to see, roughly 3 out of 5 selections outperform the stock market during their holding period here at the Roundtable. Here's a quick look at the performance, and again, we can give a little bit of a cyber standing ovation and bow because everybody's involved here, whether you're a guest damsel, guest knight, or audience participant, in addition to the regular knights of the Roundtable. Those results are all tallied together, and what you see here is an all-time record high. We're actually up to 3.1 percentage points above the stock market for the stock selected. You can see that we started a little slow. I have to take personal responsibility for some of that sluggishness early on. Some of my early selections, they just need a little bit more time to gel and perform. But overall, we are seeing an outperformance accuracy of about almost 60% at 57.6, and it has been strengthening. So here over the last year or so, some real strong performance, particularly by Hugh, Ken, and both the guest damsels and guest knights, and as you'll see here in a few minutes, the audience itself.
I think a lot of us had a weak start. I know I certainly did. But I always tell people that's to be expected, because if you're buying things that are on sale, the portfolio won't look good for a few years normally.
Yeah, and in fact, even staples will kick around here in a minute. Your early selections of staples, have underperformed, but you're making a really strong comeback here on the most recent selection of staples. So multiple positions in the same stock. So here's a look at the tracking portfolio. Again, this is just the 20 largest positions in the portfolio. Many of these are repeat selections, and again, just to help everybody that may be new to this process, the number one of the most frequently selected stocks here over the last 3.5 years has been Walgreens. He was selected it many times, but it's been selected a total of 7 times. Every time a stock is selected by any one of the participants, including the audience, we put $1,000 into that stock. So $7,000 have been invested in Walgreens over time, and you can see that that has nearly doubled now. Again, many of those selections are less than 2 years old. So pretty strong performance from Walgreens over time. So again, going down the list, you can see many of these have been selected several times over. Staples, 7 times. The most frequently selected stock is Cognizant at 8 times. Cy says he'd probably select Cognizant if he were here tonight. That's how strong he feels about the long-term opportunities and outlook for Cognizant. But again, top to bottom, some pretty strong performers. Not too many that have misbehaved too badly. One that we'll be talking about here in a few minutes, Hugh and I selected Southwest Airlines to a few giggles and groans and that kind of thing. But the $2,000 invested in Southwest is now $4,600. So I guess Hugh and I can giggle and groan back at you guys.
Yeah, but we have to admit a mistake. We should have bought more.
We should have bought more. Yeah, there's no doubt.
Yeah.
And it didn't look very pretty when we selected
it.
Oh, please. Do they still serve peanuts? Anyhow. So some
check out that portfolio recovery, just 3 spots above Southwest Airlines there, Mark.
I kind of thought that might be coming. Yeah, that would be the team effort of Ken and Ann Manning. Not bad at all for just a couple of selections. I believe it's selected twice, right? Yeah.
Just twice.
Ann and Ken at 5,000. So I guess, yeah, that's definitely bragging rights zone. And that other magic moment when Ken and I agreed on Fossil one night. Now, Fossil has been selected how many times?
Down
4
times
down
now,
here
Mark.
at 4. But 4 times has become 6,300. So again, you can see some pretty interesting selections made, and we'll talk about not only our successes, but the ones that have been more challenging, like the Landours of the world as we go. Speaking of those that have either performed incredibly well or are still waiting for operating performance to improve, this is our short list, also known as our hot seat. The hot seat stocks are down at the bottom. What I've done here is just taken and focused in on the primary portfolio characteristics of overall par, overall quality. These are both actually pretty good. We'd like to see a little more par here, a little more return forecast. And growth is actually pretty good, although we wouldn't mind seeing that be boosted up a little bit also. And this list is actually sorted by the return forecast, the projected annual return descending. So the ones at the bottom are theoretically the ones that have the weakest expectations right now. And I just kind of note a few at the bottom, 3D Systems. The reason 3D Systems is there is not because it's failing in any way. Take a look right here. I believe Ken featured 3D Systems back in July, and it was seconded by the audience. So that's why you see 2 entries here. And basically up nearly 50% since July. So it's been red hot. And if anything, it's just one you might want to pause, whether it's in an individual portfolio or a club portfolio, and then make a conscious decision to hold it or not hold it. But make a conscious decision to check in on the checkpoint. I don't know, Ken, our experience over the years has kind of been that some of the major analysts, including Value Line, really struggle with developing expectations for some of these disruptive technologies. You have any comments on that?
I agree 100% with that, Mark, that the analysts, especially some of our standard source analysts, have a very hard time when it comes to new technologies. They didn't know how to handle Cognizant 20 years ago when it first entered into the to the whole analysis spectrum. 3D is sitting with a PE of over 100 right now, and many times the PE for one of these very quickly emerging companies isn't telling the whole story. But I don't think I'd be objecting, Mark, to freezing those investments on 3D at the level that they're at right now. If you are looking to do some movement in the portfolio, I know that our par is a little bit shy, and I agree with Cy that when the par is shy, you need to do some trimming on your numbers to bring that par back up. So I wouldn't object to freezing both those positions in 3D at this time.
Okay, well, that's something we can talk about. I want to kind of scroll through and see why I would offer a kind of a dissenting opinion just based on momentum and technical conditions, but I mean, we can talk about that. And then Staples also comes to mind. I think Staples, Hughes actually had a pretty good run in many of the positions, but it still looks like it's got some momentum, and we'll take a look at a chart here in a few minutes. The one that actually reaches me that way is Southwest Airlines. I think Southwest Airlines is going to continue to be volatile, trading in something of a range, and if there's any one that we might take off the table from my perspective, I actually think Southwest Airlines might be one, because it's the type of company that does fluctuate pretty widely. And the only other question I would have for Hugh is, do you still expect the turnaround situation at Staples to stay intact, or what do you think about Staples as you think about it in a portfolio?
I think it needs a few more years. There's a lot of activity in the space in which Staples finds itself. I think Office Max and Office Depot currently are merging. So there would be a lot of instability in that whole area. Staples for me is a long-term investment. Southwest, on the other hand, has done what a lot of other airlines have done recently, which is appreciated quite significantly in value. And Southwest, I mean, it's the best of a bad bunch, but long-term, this is a vulnerable company. I wouldn't have said that 15 years ago. I used to love Southwest.
Yes, I agree.
When you look at its cost structure, it's getting worse and worse year by year. And traditionally, the way the airlines deal with that, because it's like a pyramid. When they hire, people stay there for years. Their salaries increase. When there's a downturn, the people that are let go are the people at the bottom of the pyramid, the lowest salary. So it doesn't really help the cost structure from the management's perspective that well. But what ultimately has to happen in the airline industry to correct that is they file Chapter 11, they reorganize under bankruptcy and change the cost structure. And then off they go again. Southwest has never done that. All its competitors have. Some have done it once, some have done it 3 times. I don't think Southwest will do it any time in the next 5 to 10 years, but if it continues on its current path, it will. It will have to reorganize under bankruptcy.
Definitely becoming resembling more like its competitors every day. Well, with that,
pilots are the best paid in the country.
Yes.
Or they're among the best paid for domestic pilots.
One of the things I thought I would spend just a moment going through is I would consider all 3 of those mentioned companies, 3D Systems, Staples, and Southwest Airlines, to be non-core, but all of them are different kinds of non-core, from Ken's disruptive one to Hughes turnaround to Southwest Airlines is more of a cyclical beast. And what I want to do is just kind of show 3 quick charts. And the first one is 3D Systems, ticker symbol
Mark,
DDD.
I'm going to interrupt you for just a moment.
Yeah, go ahead.
We seem to have a little bit of a misunderstanding on this last slide. If you can go back one slide.
You bet.
Those averages at the bottom, folks, are not the averages for just the stocks that you see above them. Those are the total averages for the total portfolio. So those of you that are trying to make the par average 9.8% and just looking at these stocks, you're having a very difficult time making that happen. But imagine another, I don't know, 80 or 90 stocks above this yet, and they're all impacting the bottom averages at that 9.8%.
Including all those.
Including all the top ones, right? So don't misunderstand what you're seeing on this screen. Mark, why don't you? I'm sorry for interrupting you.
Oh, that's all right.
Okay.
Shame on for all of you for doing math on the run. All right, here's a quick look at 3D Systems. Again, an extreme disruptive technology momentum story. What you're looking at here is a couple of things. I'll cover them pretty quickly. These two indicators up at the top are momentum indicators. The first one is the relative strength index. The second one is a rate of change. It's literally just the rate of change over a 12-month period for the stock price. And the reason we look at these is, again, because most of the investing world, including the trading world, looks at this type of stuff even on a shorter term basis. And what you can see here, just very quickly, just a couple of reminders. 3D shows as an overbought stock. Anytime you get up above 70, that red line that you see right here, it's considered overbought, even on a long-term perspective by much of Wall Street. So many of them are out there saying it's gotten way ahead of itself, this huge run-up, it's now overbought. But our reminder to our audience is that might be true, but that can be true for an extremely long period of time. In fact, you're looking at a 3-year period here where it's basically been overbought. So they can stay overbought for quite some time. That's why we have a second indicator that we look at, and we watch to see, when the momentum drops out of a stock. And that's what this middle one is. This rate of change is a momentum indicator. And I really only become concerned when you start to get into these points where it breaks down and the price really begins to deteriorate over time. And that is not the case right now for 3D. If I held it in a personal portfolio, I might be tempted to tinker with some kind of trailing stop protection or option protection, but I think for purposes of this club, if we come back and we monitor, for any deterioration in this indicator, if the green stuff goes away and starts to turn red, then we might be able to make some decisions about an exit point on this type of a non-core stock. Second one here is Southwest Airlines. Completely different story. It's a company that has basically ups and downs. It's showing as technically overbought. It also has a fair amount of momentum here, though, along with many of the airline stocks that he was just talking about. But you can go back over the decades and find that it basically has peaks and valleys, as any stock in that type of an industry would have. This is the one that I would say, perhaps you take your money and run and wait for the next buying opportunity that might look something like this in the future. It's a stock that you don't have to fall in love with, so I would actually pick that one to lock in and walk away from. And the third being Staples. And again, it's a turnaround story. We continue to see it. It faces extreme challenges. Hugh's thesis includes an expectation of an increase in profitability. It's going to be slow growing just because of the nature of the industry, but an increase in profitability. And notice that it's not anywhere near overbought. If anything, it's kind of in the middle of the range. And notice that all of that accumulation by Hugh for the roundtable portfolio, most of it happened in the middle of that zone right there when he's doing this deep value shopping, when trying to buy stocks near their multi-year lows. The other thing I like to point out is we don't have this condition. And Ken likes to look at these charts and kind of back up, squint, close one eye, and he's watching these kind of divergences, these kind of conditions. We've got kind of the opposite going on with Staples. So again, of the three non-core that we've talked about, I would actually throw love on the fire for, locking in those gains and maybe watching for another opportunity. What do you guys think?
Mark, I'll defer to your judgment. I'm just a little bit nervous when we only meet once a month when we're trying to follow technical indicators like this. I know how fast the stock can break down once it becomes not a darling anymore. I was following Tesla Motors in one of our stock contests here in mid-Michigan, and so I know it can break from 200 down to 130 in a very, very short amount of time. So while I'm willing to wait it out a little bit, I know 3D's made wonderful profits for this portfolio, and either way, whether we hold it or sell it, it's representing something in the portfolio, and it's there for not fundamental reasons. I put it there because I would like to have the discipline to walk away from it for 5 or 10 years and then come back and peek at it and see what it's done. This kind of goes against my whole concept of why I put it in the portfolio in the first place, but it's really dragging our total par down right now.
Yeah, and we almost have to disregard that a little bit. I would point to, here's a worst case situation here back in the depths of the Great Recession where that drop is, that's a single month drop. Every one of these candlesticks is 1 month. And that is a pretty massive drop. Same is true for Southwest Airlines, basically dropping from 12 here down to 8 and change. That's a pretty big drop in 1 month. But again, unless we launch into some sign of a deeper recession, I don't know. I don't feel that vulnerability right now. Keep in mind that you had the momentum already falling out here, and if we were in this condition, I would feel a whole lot differently than the massive green we see over here. Any thoughts, Hugh?
You can hear me. I took the mute off. Yeah, for me, Southwest is, I don't see it as having, or it's Staples now, but for Southwest, I don't see the upside for that company. The dramatic upside that we've seen in the last couple of months, the last year and a half. The economy will continue to recover. It'll continue to expand its route, but it only adds 2 or 3, maybe 4 new routes a year. It hasn't really been doing that recently. It is cutting back on the amount of equipment it's buying as well. But with these capital-intensive industries with a kind of a high break-even point, you often find that the best time to buy them is at multi-year lows. Be patient and wait.
Mm-hmm.
Because they get into an incredible price competition. When they start doing that, when they start bashing at each other on price to try to get up to that break-even point, because they're going to have to pay a lot in costs anyway, the stock just gets pummeled. And that's true in any capital-intensive industry. It can be shipping or any kind of logistics industries, mining, steel, airlines.
Yep.
You can wait for a 5 or 10 year low, and you can make an awful lot of money on them.
Well, in that case, let's kind of go ahead and call the question, if you don't mind, Hugh. Let's, Ken, any dissent on exiting the love position?
Nope, not at all, Mark.
Well, let's go ahead and do that then, and we'll just keep 3D on under the microscope for another month. Maybe have a similar conversation next month and see how it's going.
Okay.
Okay, so let's go ahead and move on. What I thought we might do here for just a minute or two is just kind of acknowledge this notion of hunting in crowds with a wow. This shows the actual selections made by the audience in the votes responding to the polls since over the last couple of years now. And there's quite a few winners on that list. I mean, the only ones that have been sluggish at all are Landauer and Vera, and we have a lot of faith in Vera Bradley. Landauer seems to be gaining some traction since their major acquisition, but anything on that list, reach out and grab you guys, other than the fact that the audience is beating 60%, and they are operating at a relative return of plus 6.4%. So they're beating the objective of 5. So again, cyber standing ovation. Any comments or thoughts? The one position that I should clarify is we did close the position in AeroVironment.
That's why
that's that one. That's why that one is shown as a closed out position. Basically taking the money and running with a positive relative return at the time. I don't know what AeroVironment has done lately.
Still really like Priceline, Mark.
Yeah, that was a good one. You and the audience on Priceline.
No, but I still really like it even today. So.
William, yep, it shows up in a lot of screens. William Shatner. I'm not terribly concerned about C.H. Robinson either, unless you think that the global recession is going to last forever. So, again, the audience has done a really nice job of selecting some stuff. So let's go ahead and give them the Thanksgiving huzzah. Pretty good stuff there. All right, let's go ahead and press on if you guys are willing. Hugh's going to come at us with Caterpillar. Why don't you go ahead and take it away, Hugh?
Yeah, I've been looking at Caterpillar for a while now. Caterpillar and Deere are the two companies that have reached the bottom of the list. I'll show you on the next slide. There's a number of companies that I track, and I look for 52 or even multi-year lows. And Ameren is a company that I talked about briefly last week. I'm certainly not entertaining a suggestion that I even buy that one, but it's one that I follow. But eBay has come under the radar screen in the last week or so. Very often I have to go back and look at the price chart to make sure that there's not some anomaly that happened 53 weeks ago that suddenly brings eBay into the mix, or any of these other companies.
And Hugh, if I might interrupt, just go ahead and reinforce or clarify, when you say bottom here, what's the calculation?
It's so if you look at the distance, if you will, between the 52-week high and the 52-week low, Amarin is currently about 3.5% from the bottom. So if the difference is, you know, $10 or so, then it's 3.5% of $10 from its bottom, from its 52-week low. And the interesting thing here is that most companies are much closer to the 52-week high than their 52-week low. This list has about 60 or so companies, I think, and you don't have to get very far down the list, 10 or 12, till you reach Vertex, which is closer to the high than to the low. So it has been very difficult for me to find companies that kind of look interesting at the moment. Target took a bit of a nosedive recently when it said its profits would be a little bit softer than normal. Lilly, I think, is probably trading higher than it should be. It's going to have a rough year next year. I don't think that's fully baked into the stock price. At least I'm hoping it's not, because I wouldn't mind buying more of the company next year. And certainly, if anything happens to one of the 8 programs it now has in phase 3, if any of those takes a bit of a nosedive, it will impact the stock, and invariably one of them will, because a lot of them are large molecules. Those larger molecules, as opposed to the small organic molecules that have populated the pharmaceutical industry for years, large molecules tend to be a little bit more vulnerable in phase 3. So we'll see what happens there. So the selection, then, if you skip to the next slide, is Caterpillar, and also on that next slide you see the projected annual return as well. eBay has quite a nice one, but Caterpillar is doing not bad at all at 9.1%. Cisco has a lot of life left in it, but I like to get these things closer to under 25%, so they're a quarter of the way. They're 3/4 of the way from the high to the low, and they've only got 25% to go before they hit their 52-week low again, or sometimes even low. But that hasn't happened actually quite often this year. Very often I'll see a negative number here where it's hit a new low, but that hasn't happened this year that frequently at all. So if we skip to the next slide, these are companies that are sitting on the top. And a lot of companies yesterday, and these data are current as of yesterday, hit their 52-week high. Yeah, you see Southwest is very near. Bank of America hit a 52-week high as well, but the price softened very slightly. But in this list where everything is coming up roses, the price doesn't have to retreat that much for it to get off a list of 15 or so companies. They're very close to a 52, and in some cases an all-time high.
Hugh, we have a number of people in the audience wondering if the colors on the company name mean anything.
For me, they do. Yeah, they. Excuse me, and I'll have to remember this because I've stopped. The red ones are companies that I'm planning to sell because they've done extremely well, and I'm not too sure how they're going to do even better. Sonic keeps hitting 52-week highs, and I've been planning to sell that for a while, but I haven't pulled the trigger. But I think I will this week because these companies are just extremely rich. And then companies like Monsanto and Disney, the green ones, are companies that I have to think very carefully about before I sell them. It's kind of a little bit counterintuitive because green would mean go, but green here means stop. and the blue ones are ones that I'm in the company drips.
Ah, interesting.
So, yeah, I'm buying directly from these companies, and for some I've been doing it for years. Morgan Stanley, I only started that a few years ago when all the banks, hit the ditch.
Yeah, I think Sonic is up like 400% in 18 months or something like that.
Yeah, it's done incredibly well. I bought it in a different company. Oh, I didn't. Sorry, I bought it when I was with Zeco, and I bought a chunk of it then, and then it just kept going up and up. And I've only ever been to a Sonic once. It was that one trip into a Sonic. I thought this is kind of interesting, and it was doing quite well. And read the numbers, and they looked convincing to me.
And Hugh, a follow-up question. This is your own chart, right? You're not getting this chart from somewhere else.
No, it's Excel. Yeah, just download all the numbers from Excel. It does all the math.
So for those of you asking, he's developed the chart himself and put all the numbers in himself.
Well, they're downloaded automatically.
Right. One thing I might point out is we did cover his philosophy and shared kind of a method back in our July 2013 screening results. So if anybody wants a copy of that, just let me know, or you can go back to the stock screen in the newsletter from July 2013. We referred to it as disciplined bottom fishing.
Yeah, I like companies at 52-week lows or multi-year lows. Always found that very attractive. And that's basically what I'm saying. For a large company, if it's near a 52-week low, because large companies I've discovered and many others learned before me, they tend to be a little bit more stable. For a very small company, I look at a 4 to 5 year low. This is a company that might just depend on one technology. Any piece of bad news can send the stock plummeting, as Ken pointed out, and it's even more dramatic effect if the company is very small. So there you can get some good bargains if you're patient, and you have to run against the crowd, because stock prices fall for a reason, and the reasons are 99 times out of 100 incredibly convincing. So you really have to bash your way up against that crowd to go buy it, because there will be many arguments, and many reasonable people who you know and love will tell you why you should not be buying the company at this time. And you will find plenty of bargains, but in terms of price, the challenge then becomes buying them in terms of quality. One list that I've often looked at to find companies that are trading at lows is Guru Focus, and there you can put in whatever search criteria you want. If you want to look at a 52-week low, you can look at companies that are, say, within 1% of that 52-week low. You can look at companies that are within 10%. Obviously, there you get a much larger list. Guru Focus is a nice resource. Good. And so what does Caterpillar do? I think we all know Caterpillar. If you drive on a freeway, you're going to run into the company, or at least its products in one way, shape, or form. It certainly has a lot of construction equipment, but recently a lot of its activities has been in mining, anything to do with earth moving, a little bit supporting the petroleum industry as well, but mining is the big area. It's a Dow component. It's based in the U.S. in Illinois, and 40% or 70% of its sales comes from overseas. Apparently, a lot of the development in the U.S. has been done. A lot of the freeways are built, etc. But a lot of activity is happening in China and increasingly in Africa and some of the emerging economies in Asia. It has 126,000 employees, but that number is decreasing as the company sheds in response to a difficult situation. That difficult situation is reflected in the stock price as well. So looking at the next slide, we see the stock selection guide. You can see, like most companies that are cyclical, and this is a cyclical company, you wouldn't think that because of the sales, but look what happened during the Great Recession. Sales did take quite a nosedive. The profits suffered even more. But it seems to be back on track. However, recently, sales have started to decline again, and I'll talk about that in a second, why that has happened and why it may discontinue, why it might stop from happening going forward. And you can see the little bar there that shows the price range. The last 52 weeks is trading reasonably close to its 52-week low at the moment. Now, the historical growth rate is 9.2%. I selected 9% going forward, which is significantly more optimistic than some professional analysts who do this for a living. But I often find that people who do this for a living are often biased by what's happened most recently. And it's difficult to bring yourself back and look at a 10-year history and convince yourself that this company will right itself and will get back on track or close to back on track. And on the next slide, you can look at part 2 of the SSG, and it shows also the assumptions that were made in creating the stock selection guide. The number of outstanding shares is the most significant issue to me at the moment because it is declining. And when I look at the number of shares outstanding, when I looked at this before, which I think was April, I believe there were 633 million. And so there has been an active share buyback program at Caterpillar, and those numbers are decreasing. But both the 5-year average pre-tax profit on sales and the return on equity are trending appropriately. They're trending up. The ROE has dropped recently, but the company has made an acquisition. I had hoped to present an analysis of the inventory, but I didn't get a chance to do that, so I'll prep it for the next session that we meet. And then on the next slide, we can see the behavior of things like the price-earnings ratio. It has a decent dividend. Wouldn't perhaps buy it necessarily for the dividend. But the PE ratio range is quite has been quite large for the last few years. I've settled on a range of 16 for the high and 10 for the low, and then use that on the next slide to project a high price for the next 5 years, and selected a low price, which is about 20% below where the stock is trading now. It's about 10 or so percent, excuse me. And so based on this analysis, it has a very generous upside-downside ratio of 5.6 to 1. And there's what the PE has been doing for the last 10 years or so. You see it took a bit of a jump in 2009, but that's more an impact of what happened to the price and the earnings rather than anything else.
It's
but it has been relatively stable. Yeah, that was the Great Recession. And then on the next slide, you look at the data presented a little bit differently, but I selected a range of 16 for the high and 10 for the low, which I think was relatively conservative. And fed it in. If we move forward one more slide. Oh, I thought there was another slide here, but this is part 5 that shows the projected growth rate. You can see on the bottom left we have information that was obtained from the Value Line Investment Survey. Caterpillar being a Dow component, the Value Line report is free. You can download it from the site. But the sales growth projected from 2016 to 18 is kind of sluggish. It's only 5 or so percent. But we will see if that holds up. As global economy recovers, that should pick up. And then moving forward, we can look at manifest investing. Take on Caterpillar there, the projected annual return is 9%. It's not a bad number at all. It's probably not where one that would like to be in a portfolio overall, but this can make a decent contribution to a portfolio. It's a relatively stable company. It has an A+ financial rating. I like the fact that the CAPS rating on this is low, but a lot of analyst reports that I tend to like, the Street being one of them, have rated this company as a buy. They've projected the shares outstanding here to be 644, but they seem to have had a bit of a buyback recently, and that number's even a lot lower than that at the moment. But we'll see what it does in the future. I can't imagine it made an acquisition recently. It was in the mining industry, so it bought it right at the wrong time. It bought it at a high, and that industry has gone into a little bit of a recession, so it's suffering as a result. So I can't imagine that there'll be any more acquisitions in the future, but in the near-term future, but we will see. And I think on the next slide I discuss the fact that the company is suffering right now. Mining equipment sales is very weak. It makes a major contribution to the company's profitability and top line. The company has been downsizing in response, but generally when you look at prices of some of the metals, gold, copper, etc., those prices are recovering, and mining activity is beginning to recover as well. So that could be good for Caterpillar. But it takes a while before people make major capital investments again and start buying new equipment. So it could be a year or two before what we're beginning to see in the mining industry, which seems to be an upturn, we won't see that for a few years before it's reflected in the Caterpillar stock price or the numbers in the stock price. So skipping along to slide 28, just summarizing what kinds of things I was saying, that things are looking up for mining. There is good news in the company. Cash flow is pretty strong. Earnings are relatively stable or getting there, even though the revenues are down. And then skipping along one more time, I like to buy Caterpillar. It's a leader in its space. The news is bad, but bad news is a place I go to look for good bargains. And I think the share price will continue to be impacted. Nothing really has changed from what I said a few months ago. And for me, it's a long-term position. So I want to add more Caterpillar to the portfolio.
Well, thanks very much, Hugh. We'll be taking a closer look at that one probably going forward, and remind me sometime we might want to talk about how the number of cycles might affect that long-term forecast. It might be one of the things that kind of screws up what the rhinos or the institutional analysts see and use. So we might take a look at that. But thanks again, and let's go ahead and move on. We'll take questions afterwards. I'm sure we'll have a little bit of extra time here today. Let's turn the gavel over to Susan Michalik. First, a note about Susan. We're thrilled to have Susan with us here to talk about Ulta Salon here for a few minutes. Susan is one of the leaders of one of our winning stock-picking investment clubs, the Bower City Group of Ladies out of Janesville, Wisconsin, and Susan herself has been a participant in a number of educational and stock picking exercises over the years, and we're just thrilled to have you here. Good morning, Susan, and take it away.
Thank you, Mark. It's an honor to be here this morning. I want to first say that my approach to picking stocks is a little bit different than Hugh's. I don't have a lot of charts and lists and things that I look at. What I looked for today was I thought about, oh, not yet, back up.
Okay.
Industries or companies or things that might be interesting based on the economy and the world situation, whatever. So I started thinking about aging boomers and people, and know that healthcare has been a popular industry for people to be investing in. I was thinking, what else do boomers like to do? And everybody actually, and that is look good. So I looked into the beauty and health industry, and I found this company called Ulta Salon. The actual full name is Ulta Salon Cosmetics and Fragrance Incorporated, and that pretty much tells it all. This is the SSG with just sales and earnings. You'll see that the lines are up straight, more than parallel. Earnings are growing faster than sales. It's a medium-sized company based on sales of $3 billion a year, but based on its growth rate of more than 20%, it is a small company. So on to the next slide. So this is how we all hope we could look. Now, the similarities between this model and me are many. First of all, we both have brown eyes, and we both have a mouth, and we're both female, and that's about it. So what does Ulta Salon do? It is a beauty retailer. You can go to the next slide. And they have one-stop shopping for prestige, mass, and salon products and services in the United States. They have 609 stores in 46 states. There are some in Wisconsin. I have never been to one, but there are some here. They have an interesting format in that the salon area is divided into 8 or 10 stations, and each salon area has each station has concierge desk, skin treatment room, semi-private shampoo, and hair color processing areas. And each salon has a full-service salon offering haircuts, hair coloring, permanent texture, etc., etc. Anything you would possibly want for beauty is available at these areas. The stores are relatively small at 10,000 square feet, and they carry 20,000 SKUs. I had to do a little research on what an SKU was, but it's a stock keeping unit, so that's the number of products in each store. And within that, they have over 500 brands. So they're either private or public labels. They also have a very fast-growing internet presence with e-commerce. That particular segment has grown 75% in the last quarter. And they have a loyalty program with their continuing members. Next slide, please. The company is based in Bolingbrook, Illinois, so 2 for 2 for these companies this morning.
It's a good trend.
Yeah, it is. These are the top 2 slides are examples of things you'll find in the store. On the lower left is an actual store itself. Interesting, they are off-mall locations, which mean they are not in malls, inside a walk-through mall. This probably is a disruptive technology, Ken, drawing people away from malls. I personally have not been in my mall for many, many months. I will be there for Christmas, but traffic, as we know, is really falling off in those very large areas. So this is one plus for the Ulta franchise. Okay, next slide, please. So all of these slides that I've shown so far have come from the Ulta.com site, their website, and I went to Investor Relations, and lo and behold, there was a investor presentation. So that's one nice way. Thank you, Ken, for bringing that to our attention many, many months ago. One way to help investigate a company. So these are the company's bullet points on why you should invest in their company, and you can read them. They're all pretty generic, but it's just nice to have it all in one place. Okay, next one, Mark. Here's a growth or chart actually of their number of stores at year end. You'll see from 2008 to 2012, despite the recession, Great Recession, they did expand their business. They went from 311 stores to 550. They're looking into, by the end of year 2013, of having 655 stores, or 675 stores. The sales and comparable store sales has increased again very consistently with a combined average growth rate of over 20% over the years. The last year is only 8.8, which is still great for same-store sales. Net income, of course, has just again 62%. What do I need to say more? It's done very, very well.
Yeah,
Next slide, please.
Dramatically rising profitability here.
Dramatically, and part of that is the number of stores that they have open, but they're doing quite well. So who actually goes to these stores? Well, I think one of the nice things about this is it appeals to women of all ages, not just to the baby boomers or mature women. So this is not a trendy store or a trendy product. I'm not often a fan of retail because of how tastes change. I mean, what's really hot now or the next 6 months may not be in a year or so. But this particular company has beauty products. Well, I'm sorry, beauty products are here to stay, and we're always going to, women are always going to keep using them. The store also does have products for men, but they're mostly online. I'm not sure that they really cater to traffic from men in their stores. I don't know. So the stores are located in suburbia, and they're usually in areas of where the more wealthy people live. The average person buying in the store comes from a household with income over $70,000 a year. They're fashion conscious. They also appreciate the one-stop shopping. Going to the mall, parking, schlepping through the whole place, going into a department store, one place for your perfume, one place for your makeup, another one to have your hair done. This Ulta you can do everything all in one place. They are committed to having a welcoming, friendly environment. That means that they don't have, their employees are not on commission, so they don't have, there's not the cutthroat competition from people trying to help you. Next slide, please. So what are they planning on doing in the future to grow? Well, I've said they're going to increase their number of stores. They have a couple more states to get into. They are going to expand their square footage of their stores a little bit. Now, they don't want to get them really big, but they want to make them just a little more friendly. So that's about all on this slide. Okay. Looking to the value line projections, this value line is from the beginning of this month, I believe. The projections of the high total return of 14% and the low of 3%, okay, not real exciting, but okay. So we'll move on. Oh, then also on this list, the net profit margin, which I forgot to circle, but Mark can find it here on the bottom, has been increasing steadily and is projected to even get better in 5 years out, 3 to 5 years out into the future. So those are all good signs. Next slide, please. Oh, also it has no, oh, go back again. The company has no debt under the capital structure. There's absolutely no debt here, which is pretty amazing since they grow by opening new stores. So they have lots of cash. All right, and here's the actual data on this value line, November. This analyst write-up on this particular company ends with saying that he thinks it will probably continue posting strong annual earnings and has more room to run. So all these things looked very positive to me. We'll look then at the Manifest Eagle, I think. Oh, no, here's my SSG. The growth has just been stupendous on this company. It's been growing at over 20%, 25% increase every quarter for the last 1, 2, 3, 4, 5 years, and it's projected to do the same into the future. For my projections, I use 20% just because I'm a little more conservative. The sales, again, are right on that line of 20% growth. The dotted hash line for the projection is actually from the last trailing 12 months data. If you brought that down to the annual data, it would be straight through those green S's. So it is right on track. Next slide, please. So on my SSG, the PE ratio of this company is currently at 43.5, which is high. As we all know, the PEs of many of our stocks, or many stocks, good stocks in the stock market right now, are high. The historical high PEs of this company have been in the 30s and the 40s, not as high as 43, but they have been relatively high, as have the low PEs. They've been in the 20s and the 30s. So when I went to 4A to choose a selected high PE, I didn't want to go as high as 37. I didn't want to go 43. So I checked the 10-year high PEs, similar to what Hugh was doing earlier, and I chose 33 from that. That's the 10-year high PE. Let's see, the only other adjustment I made there was, let's see, for my selected low price, even when they did the math for 4B, that came out too low, so I chose 75% of the current price. I know some people go as high as 80, but I'm a little more conservative, so I chose 96 for my selected low price. And doing all that math came down to the end of a projected average return of 7.1, which is maybe a little lower than what I want, but again, I'm more conservative and I'm more happy as long as it's positive almost. But that's acceptable to me. It's not great, but it's acceptable. So on to the next slide. This is the Eagle from Manifest Investing, and it's a little more aggressive than my SSG, meaning that the growth rate, the sales growth rate was less, but he chose that the margin was higher, and they ended up with a annual return of 12.9 as opposed to my 7. And that's okay with me. That's great. We ended up with a price that was just about the same for the projected average price. This one gives 188, and I think mine was 170 something. If you back up again, if we could peek at that. Well, the average there between the 96 and 174 would be close to that. Okay. So I present Ulta Salon Cosmetics as a possibility as for a addition to the portfolio. Has tremendous growth rate, no problems with the recession. Is an industry that I think doesn't have dips and valleys, and that's it.
Well, it's been said by some of my colleagues that there's never a recession in male vanity, so that's coming along pretty well.
I did want to mention this morning as I was getting ready, and I'm not a real fussy person, but I counted 14 different products that I used to get ready, from taking my PJs off to getting dressed, with the shower and the shampoo and the makeup and the different lotions or whatever. So 14.
Oh, cool. Well, thanks, Susan. Definitely
Okay.
the improving profitability story there is quite compelling, quite powerful, and probably worth keeping a close eye on for investors. So thanks again, Susan, and let's go ahead and keep moving on. Ken wants to talk about bread, the St. Louis Bread Company. Go ahead, Ken.
That's the original title for this company, Mark, and we're taking a look at Panera Bread. Mark, where did you get those high-low projections from? Is that a brand new value line that just came out?
I think so. It's relatively new. I don't know
Okay,
the exact
because
dates.
my value line is almost 3 months old and has significantly different numbers on it. So that's very interesting to see these new projections out here.
Oh,
I'm looking at,
that's
go on.
probably an error. Sorry about that. That's probably a mistake.
Okay.
They're lower.
Uh, yeah, they are. I'm
Ignore those.
looking at earnings lines here, and in fact, Mark, if you could switch to my screen, I'd like to show a number of
Sure.
different tools if I could.
There you go, sir.
Thank you. And I'm going to start just because I can. I'm going to show you the brand new SSG Plus tool from Better Investing. And if you'll notice, it looks very similar, the graphs do, to the toolkit. I'm looking at lines that are certainly moving in the right direction. They're moving up. They're certainly extremely straight, and they're about as parallel as you get a set of earnings, profit, and sales lines to be. I can pick out the recession in here. There was some flattening for a year or so period of time, but it's not a significant disruption in the sales growth for this company. So I think Panera certainly rises to the level that it's something you might want to take a look at. I predicted about 13% growth both for sales and for earnings per share. And I'm choosing PE values that, while a little bit aggressive, I don't think they're stratospheric. I think I have a 30 at the top end, and I think I have a 21 at the bottom end, to give me an SSG that gives me about a par value of a little bit less than 11%. I'm going to click on a few other things here. Here's the value line sheet for Panera, and that projection box
Yeah, that's
should
the
look
right one.
like this right here. I'm looking at a low projected return of 6, and I think that's a little pessimistic. Panera came out in its second quarter and did not do exactly as well as people thought it might, and maintained all of its projections going forward. And then in the third quarter, they ratcheted down expectations just a touch. I think the market really punished the company for that, and I think that these projections probably reflect that punishment. I'm looking at, get to the right place here, Kavula. Here we are. I'm looking at some slides, and you get a rough idea of how large Panera is, 75,000 employees, United States and Canada. This AUV is a measure that the company uses to give total dollar numbers per store. So about $2.5 million coming per restaurant. That's a pretty decent number for a restaurant that serves bits and pieces and doesn't serve full sit-down meals. Panera likes to call itself a bakery, but it's actually a bakery that takes dough from different major centers, and that dough is delivered fresh daily, but you can see there's not nearly the number of dough centers as there are restaurants. So the dough is coming from these distribution centers, and that gives a consistency to their product that otherwise they probably wouldn't be able to maintain. Notice the strong growth both in franchisees and in company-owned stores. Panera's stated goal is to keep the franchisee number and the company-owned stores roughly 50-50. Right now the franchisees are a little bit more There's more of them than there are of the company-owned stores, but they're roughly equal to each other, and exceptional growth going on in both segments. Here's the penetration, and what they like to point to. Let me interpret the colors here. The dark colors, the really, really dark green in Ohio and Missouri, are the two states with the most Panera stores, followed by the states in gray, which have the second most number of Panera stores, followed by the yellow and then by the light green. And they like to point out that some of the largest states in the country are still light green. They also have a swath up here in the upper Midwest and in the upper West where they don't have any stores at all. But Panera likes to point to the fact that there's plenty of room for expansion. Notice that except for Ontario, there's not a lot of Panera in Canada, and there's no Panera of any kind down in Mexico. So they really feel that there's a lot of room to expand the stores. Here's their expectations, and it amounts to 15 to 20% earnings growth over a long period of time. And they'll do that through same-store sale expansion, unit expansion, that means more stores, raising their margins, and then, of course, doing some acquisitions and some share buyback. Panera does make minor acquisitions of various restaurants, but they haven't made a major acquisition in a long while. Let me go back then to my toolkit and just take a look real quickly at the lines again, just to give you this other set of data. This data is coming from the same place, and I've kind of decided to look at let's not look at 3D systems. How about Panera? Okay?
That looks pretty disruptive.
Yeah. And here's Panera, and again, I just want to emphasize that you really haven't seen any major hiccups in the company for a long while. They were challenged a little bit in the most recent quarter, and that gives you this idea then of this disruption that's occurring in the price. I'd like to go, if I could, real quickly to the Manifest Investing site. And I've somehow lost it on my screen here, so I'm going to pull it up real quickly. And I'm going to stocks, and I'm going to type in PNRA. And I'm coming down to this chart that's at the bottom of every one of the stock analyses, and this is a poster child for the kind of stock that I like to buy. I'm looking first of all at near constant quality. I won't look at a stock when the quality is on decline. I don't mind it, ticking up or down 1 or 2 or 3 or 4 points as long as it's in that 80 plus range. And this one has stayed up near 100 now for a significant period of time. But what I like to see even more is this historically high value for par on this particular stock. If I look back over the last 4 or 5 years, I don't see any value as high as this one that it hit back in August, and the par value is still sitting for my SSG and for Mark's analysis. Mark says par is at 11. That's almost smack dab to what I calculated. I still see par up in this area, and again, I trace it back, and I hardly ever see Panera giving me this much potential return. So that tells me that it's something that I really would like to take a look at. In addition, in the restaurant group, it appears to be the top stock, 98 quality rating. So all in all, I think it's a very interesting stock. I did confess before we began the session that I usually hate restaurant stocks. I've been very unlucky when it comes to restaurant stocks. So with that in mind, with Buffalo Wild Wings being my only outlier to that statement, let's see if I can make some money on Panera going forward, Mark.
It's a pretty good story, and they're also a very charitable organization for those of you that follow that sort of thing. Giving away lots of food to soup kitchens and that sort of thing. So good stuff. All right, we've got I've got a pretty quick set of slides on Apple. If you want to switch the slides back to me, Ken, or switch the display, or do you want me to do that? I got it. Okay. I'm going to go with a repeat selection of Apple. Apple is no stranger to any of you. It's the most widely followed stock by all of our subscribers. Just some real quick notes here as to why I picked it in the first place. Again, like I was saying, Cy also likes Cognizant today. That it does end up at the top of the list, but we have selected that so many times. This Proto Lab shows up in the Forbes list of best small companies for this year. Just came out a couple weeks before Halloween. I love the concept, love everything about the company except for in order to achieve that, they're going to have to keep their PE ratio over the long term up in the 40s, and that just makes me a little bit skittish. So the third one down on the list is Apple, and we'll take a closer look at Apple. Moderating growth, decent operating characteristics across the board, but let's go with Apple. Here's a quick look at the company, and again, we counsel that the low total return forecast might be the one you want to use as a second opinion to audit against, and we see a nice mid-double digits or mid-teens number for Apple. And the company has kind of moderated. They had that dramatic growth cycle with all of the new stuff, and they continue to work on new stuff, but the company has moderated. If you were one of those people that thought that this company was going to continue along that growth trajectory, we just know that's not possible by the law of large numbers, if nothing else. But the company has kind of stabilized, very high quality company over the years, but now looking for a growth rate, somewhere in that low double digit range is probably not too outlandish. Here's a quick look at the summary showing that that the analysts agree with that assessment. And when I say analysts, we're talking about Value Line, Morningstar, Standard & Poor's, the analyst consensus, or whatever. We're talking about a company generating, again, 10 to 12% sales growth, dramatic profitability in the low 20s, and a PE ratio which basically, in my opinion, fails to respect the overall quality of the company, but it also has one eye, or it's cognizant of the rather dramatic cyclical swings in this company over the years. So that's why they get tagged with a PE ratio that's more appropriate for a more cyclical company. Even with that 13, using the assumptions shown here, we're talking about a really nice earnings forecast. And again, it's been as high as 700 recently. It got back into the 300s, and now it's actually crept back into the low 500s. Here's a look at that long-term price chart for Apple. Those of you who follow Manifest Investing know that we were quite concerned about this long run where it was overbought for a long period of time, and the momentum did drop out of it back here about a year ago. And we're a big fan of trailing stops back then, and anybody who deployed them was actually handsomely rewarded. The company did drop down to 385 and has now recovered about 100 points. We did feature it as our stock to study, or our featured stock for Solomon Select, back at the early part of June with the price closer to 400. So we're quite happy with where that's at. Again, what we're hoping to see is, one of these prolonged periods of momentum. I mean, it stays overbought for long periods of time. We're not there yet. We're actually closer to a oversold situation than to an overbought. Notice that there's only been 2 dramatic buying opportunities in the last 10 years at Apple, and neither of them reached the oversold. So this is something that those of you that follow charting at all, this is a company that never reaches oversold. So anytime it gets down below 50, you almost have to treat that as an oversold condition. That's basically what we were looking at back in June when we picked it. And again, we're hoping to see this continue on a trajectory like it has in the past. No reason to believe that it won't, with their continuing innovation and a lot of good stuff going on. So again, kind of a value or a snapback proposition. We'll go ahead and make Apple a repeat selection for the portfolio. So with that, Ken, if you're ready, we can actually go ahead and do an audience poll and see if they can improve on their long-term results.
Sounds good, Mark. If you give me just a moment to get this ready to go. And I'm going to launch the poll. Forgive my fat-fingered typing if you see an error in the spelling, but here we go. That poll is now launched. if you folks would just take a moment and use your mouse to click a choice, we'll leave the poll open until we get maybe 3/4 or more of our audience voting. We're up to 60% voting. It doesn't hurt, folks. Just take your mouse and go up there and click one of those stocks. Nobody's going to know which one you chose.
So Ken, when I asked for, I want to vote twice for Mark's stock, that doesn't show up here anywhere.
No, it doesn't, Mark, and it's not showing up in the voting either. So,
right. It's such a cruel slapdown.
I know.
I'm going to cry myself to sleep tonight now.
Okay. Well, just don't get too feisty, or we'll have to show the results of the Mid-Michigan Stock Pickers Contest to everybody.
All right,
okay?
I'll be quiet now.
All right, good. All right. I'm going to give you about 8 more seconds, folks. Please just take a moment and pick a stock and vote so we get a good representation going on right here. And I'm going to close the poll now, and I'm going to share the results. And by an extremely slim margin,
we're
you
going to call that a tie.
Decided, yep, I wouldn't have any problems in calling that a tie. Looks like Panera Bread just edged out Ulta Salon Cosmetics. Hughes Caterpillar is a respectable third, and we have Apple bringing up the rear here. We actually have a few folks, 3 or 4 of you, that have decided that none of the above are appropriate. So, Mark, I'm going to hide the poll, and we should be back to your screen now. There we are.
Okay.
I'd like to announce that our next roundtable is on December 28th. We're going to go back to a weekday. We tried a Saturday. Some of you tell us that Saturday is a really good day for you, but it probably was bad to choose a Saturday during the middle of hunting season. We lose most of our northern audience here when the deer are out running. So we're going to go back to a Monday night on December 28th. In April of 2014, the Mid-Michigan chapter and the Southeastern Michigan chapter are going to be jointly sponsoring a Stockorama. So give us a shout out. Come and visit us if you're anywhere near Mid-Michigan or Southeastern Michigan. Exact date and location are yet to be determined, but we'll certainly keep you up to date as the date gets a little bit closer. And then, of course, in May, we'll be at the Better Investing National Convention. Mark and I were committed last year and weren't able to attend. Neither was Hugh, but I do think that all 3 of us will be back in Chicago, Illinois from May 15th to 18th, and we look forward to seeing you at that particular time.
I think Susan will be there too.
Absolutely. Susan and a lot of our folks in the audience are going to be there as well, giving us a hand. I hope to have a really, really great time at this convention. I won't have any major responsibilities other than having a good time, so that'll be new for me. Mark, thank you as usual. Hugh, a special thanks to you and your upside down theories of investing. It's really, really interesting and informative, and it's teaching
and successful.
me a few new and successful and teaching me a few new tricks. Thank you. And Susan, I can't thank you enough for just stepping in at the last minute and filling in for our Cy Lynch. Cy is busy studying to become an ordained minister, and he's finding that some of the responsibilities that go with that study are taking quite a bit more time than he expected, but we hope we'll be able to attract Cy back in December again.
And we'll have Susan back again soon too.
Absolutely. And Mark, I'll let you close us down, okay?
All right. Well, thanks, everybody. I'm going to go ahead and shut down the recording. We will stay around for those of you that are joining us live to address some Q&A. But again, thanks, everybody.